Now, Access Holdings gross earnings rose 88% year-on-year to 4.87 trillion naira, as captured in a financial statement for the year ended 31st December 2024. Meanwhile, United Bank for Africa's profit after tax rose 33.1% in the first quarter of this year to 189.84 billion naira. Will the FUGAZ sustain their momentum this year? Nabila Mohammed, banking sector analyst at Chapel Hill Denham. She joins me now for more of this and movement in Nigeria's equities market. Nabila, thank you so much. Pleasure to have you.
Thank you for having me.
Well, look, we're seeing some strong earnings from the top banks here in Nigeria. Let's start with Access Holdings. Earnings up 88% year-on-year, 4.8 trillion is what the gross earnings came in at full year 2024. Looking through the line items, what stood out for you? What jumped out at you?
I mean, the first line item that jumped at me was the interest income. We saw it strong at over 3 trillion naira, and that is remarkable because we understand how 2024 was for the banks. We understand the high interest rate environment, but that is just one factor. You have to also put into consideration the ability of these banks to deploy their funds to high-yielding assets in order to earn so much in interest income. So I believe that played out if we're looking at interest income alone. If we look at fees and commission, they did very well. In fact, they beat the average if you're looking at the tier 1 peers of over 57%. So it's just remarkable how they were able to rake in so much from all their income lines in order to post the 4.8 trillion that we saw in gross earnings for them.
Interesting. And like you mentioned, I mean, 2024 was a challenging year, but I mean, with the reforms that we're seeing, the strength of the reforms and all of that, it appears the environment may be better this year. But and speaking about that, Q1 for UBA, profit after tax up 33.1% to 189.8 billion. Is that part of what we're seeing?
It is speaking to how important it is for the banks to be able to develop their core earning stream, because we are beyond the phase of FX devaluation and FX gains and all that. So it's now strictly what your business is doing in terms of raking in funds from the loans that you book, good quality loans that you book or you have in your book. So if that is the case, then we should see interest income still strong for them in 2025 beyond any FX movement. We should also see fee and commission if they are able to invest in their IT infrastructure in order to make sure that fees and commission is steadily coming through and their trading income as well is steadily coming through. I believe all this played out for UBA in Q1. Although we did notice some drops in terms of their assets, because we see that on a year-to-date basis for loans and advances to banks, it dropped by 77%, and for loans and advances to customers, it dropped by 1.8%. Now, it could be as a result of maturing obligations, or maybe they were not able to book as much loans as we saw previously. But if that is sustained all through the year, then they may see a slowdown in their PAT. So we expect them to pick up in the subsequent quarters in terms of growing their loan book.
Right.
The absolute organic growth now beyond, of course, any movement.
That was going to be my next question. I mean, because looking across, I mean, especially for the top banks now, the loan book growth. I mean, because the question we keep getting asked is, are these banks really lending to the real economy? Are they supporting? Especially, I mean, I know some of SME-focused banks, but for the big banks, obviously, they take on bigger, ticket deals and all of that. But generally, for all of them, both, tier 1, tier 2, are they lending to the real economy? So for the loan book, are you seeing an expansion, significant expansion, or are they still sticking to the traditional sectors that, where they, tried and tested
Well, we're seeing them diversify. We're seeing them talk about lending to the SME space and how they are trying to make sure that their loan book expands to that level. But if we're looking at the growth itself, for 2024, largely, of course, was FX movement. But we did see some standouts in terms of organic growth. I mean, talking 17% for the likes of Zenith. So it's possible that out of the 45 or 50% that we see some of them record in terms of loan growth, there's some level of organic growth that occurred there, and we will definitely see that play out in 2025 because that is what we expect, since there's going to be FX stability relatively. So we should see organic loan growth, and we do not expect any bank to post anything below 20% if truly they are deploying funds to the real sector of the economy in order to grow it as they are supposed to, given the fact that that is their core business.
I know when we talk about expanding loan books, the loan to giving out loans, there's always the issue of NP non-performing loans. Is that because I know Fitch put out a statement or a report saying non-performing loan ratios to rise on high inflation and interest rates. But I mean, what are you seeing?
Of course, it's very important. It's not just one thing to grow loans, and it's also another thing to make sure that you're growing it right. So you don't want to book loans that are not of quality in your books, because eventually you would pay for it in terms of all the restructuring processes that goes into all that. And on average, we did see non-performing loans for 2024 inch higher. In fact, for First Bank, we saw it go as high as 10%.
But don't they make provisioning? I know some of them do increase their provisioning.
So the provisioning is most times at management's discretion, and that is where credit management has to come into place, because when we're looking at the stage 2 loans, that's like the categories of loans that they have in their books, stage 2, stage 3, it's very important for the banks to pay attention to any movement that occurs in the between the stages of these loans, because if they're not paying attention to that, then we may see them in a particular year booking so much in terms of making provisions for that particular, or making impairment in terms of that particular loan. But we don't want that to happen to them. So we want to make sure that their credit management team, of course, is paying attention to whatever movement it is that occurs across the stages of loans that they have in their books.
And we know that the CBN is also watching very closely how these MPs are moving. But thank you so much, Nabila. Always a pleasure to have you with us in the studio. Nabila Mohammed, banking sector analyst at Chapel Hill Denham.